equities. Daniel Morris, global strategist at JPMorgan Asset Management. Daniel, thanks for joining us.
My pleasure.
Today, how are you feeling about this bailout fund, the prospects of it being boosted to a size possibly as high as 940 billion? Good for equities?
But it's nice. I don't know that it's really all that significant in the end. I mean, the whole idea with any kind of insurance policy, if you actually need it, you know, that suggests that things haven't gone very well. And if we got to the point that you had to tap this fund, probably the situation in Europe is pretty bad. The amount of money that would really be necessary, say, to backstop Italy or backstop Spain is much, much larger than this, much more than Germany or other countries are willing to step up to. So I really think the key issue is, how is Italy progressing? How is Spain progressing? And the backup fund is, in the end, probably not all that important.
How are they progressing? I mean, Italy's having problems with this labour law.
Sure.
Spain, of course, strikes today, budget tomorrow. I mean, it's implementation. It's all about implementation, isn't it?
And I think that's what explains what's been going on the last couple of weeks, that after the big rally, now we're at the point that, you know, let me see how you're doing. Are you going to be able to stand up to the unions? Are you going to stand up to the politicians who don't want to support the reforms that you're proposing? And I think it's really going to be a process of hopefully 2 steps forward and just 1 step back.
Yeah.
But as that happens, yields are going to reflect that. Sometimes they'll be higher and lower, but broadly speaking, should be a progression.
I mean, you're shorting sovereign debt, core sovereign debt, bonds, yields, and especially treasuries. I mean, I asked Moritz Kramer this half an hour ago. Could yields in Italy and Spain head back to their highs, the highs of November, or are we safe around 5.25%?
I mean, I think where we've been recently over the last couple of months is you could say it somewhat approximates fair value, you know, reflecting accurately the risk that these countries represent. So as that risk changes, I think they'll change marginally. When we are at rates like 7%, that was more a reflection of, you know, worry about the Eurozone as a whole. So, and I don't expect that, so no, I don't think yields will get that high. But yes, it could rise a bit, but then I ultimately expect them to decline.
Okay, now, your strategy, interesting. Risk assets, yes. Tick. Cyclical equities, tick.
Sure.
Tick technology. But you're coming out of financials principally because they've outperformed?
They've done really, you know, obviously very well.
Yeah,
they've led most of the sectors so far. And, you know, fundamentally, the outlook for financials at this point is still pretty challenging. I think it's primarily regulatory, at least largely regulatory. I think you still see among politicians a desire to kind of make someone pay, and the banks seem like the ones that perhaps have some of the money. So I think the outlook there is going to be tough. And also difficult to predict, so there may be, I think, better risk-adjusted opportunities.
And is that why you're just rebalancing the portfolio away from equities into emerging market debt and high-yield debt? Is that why that is?
That's not really why, but I think with the rally we've had in equities so far, I mean, 25% really since last fall. You know, it's a point where you think, well, you know, that's pretty good. Where's the next bit going to come from?
Yeah.
And we're certainly not going to get another 25% through the rest of the year. So if you look at, say, 7-8% or so total return for equities compared to about the same yield on coupon for, say, high yield debt and emerging market debt, I'm probably more sure of getting that part of that return than with equities, where it's got to come with some more price appreciation. So again, the risk-adjusted opportunity, I think, is better in some of the higher yielding fixed income.
Such as, give us an idea.
Well, certainly, I think fixed income in general is very good, especially again on a spread basis. I mean, relative to treasuries, the extra yield you're getting relative to the risk is, I think, still very good. Also, with emerging market debt, in some ways, absolute yields are low, because the risk of emerging markets, especially at the sovereign level, has fallen over the last decade because they're much better off fiscally. But still, relative to treasuries, relative to gilts, very attractive.
Got to talk about oil, Daniel, because in your notes you say another month more could be the tipping point. I'm talking about oil prices and the fact that importing countries are having to import oil and the prices are rising. A tipping point? That sounds a bit worrying.
Well, I think it's the point where instead of with oil prices high, if it's relatively short term, I don't think it has much impact on consumer spending or companies' decision making. But it's been about a month now that we've had prices about 125 or so for Brent. If you look at what happened last year when it was Libya that was causing prices to be high, I mean, the slowdown you had in the U.S. economy, I think, was partly due to that. Prices in the U.S. were at elevated levels for, you know, a bit over 2 months. So in another month, we'll be getting to that 2-month point here. And then you start thinking, well, I'm going to have to revise down my GDP forecast a bit. Nothing catastrophic. So it's not like it's going to be a recession, but you do have to temper your expectations.
And give me your expectations on China, because I know you think no soft landing, but often people say that. But even if it isn't a soft landing, it could be detrimental to many other markets. So how does it play out, the China story?
Well, I still actually do think it's going to be a soft landing. What's really tough now, though, given that there's a very vibrant debate about how hard a soft landing is, and so you want to look at the data, but it's very difficult to interpret the data now because with the Chinese New Year, the year-on-year comparisons are difficult to understand. So we really have to wait to see what comes up over the next couple weeks. But broadly speaking, I think even if it turns out to be lower than we expect, the government is very willing and very able to either stimulate through fiscal policy or monetary policy. So in the end, it may not matter. I think you kind of get to the soft landing either way.
Dan, thanks for joining us today. Daniel Morris there, global strategist at JPMorgan Asset Management.